Welcome, everybody. I think we should just go ahead and kick this off. And you know how it is, people will continue to trickle in through the door. So thanks, everybody, for coming to day 3 of the Africa E-Mobility Week. I'm filling in for Warren today. We're very pleased to have this great panel here, folks to talk about financing for the e-mobility transition. We all know there's significant amount of capital needed to make this transition happen and to speed this up. And we've got some folks who have been working on this issue from various angles here. We have Garrett Ko from PIDG, Tugende, who we all know as a Boda asset financier, and WRI, World Resources Institute, who are working on this angle. And they'll give themselves more of an introduction. And our very capable moderator here, Mercy from the Kenya Technical University. And I will go ahead and pass it over to Mercy. Please do drop questions, comments in the chat. We'll get to those questions and get some good conversation going there in the chat. Mercy, I'll hand it over to you.
Okay, thank you so much, Tom. Yes, so I'm Mercy Edna. I'm from the Technical University of Kenya. I teach transportation engineering, and I'm happy to be the moderator for this session today. Yeah, so I would like to start by giving everyone here a chance to tell us something about the different institutions that they come from. So I think we will start with Goransko first, and then we can go to Paul and then Jafet.
Sure, thanks, Mercy. So my name's Ben. I work as an associate director in Garanco's Nairobi office. Garanco is part of the Private Infrastructure Development Group, which is based in the UK, in London. Is a multi-donor owned one-stop shop for infrastructure projects. The idea is within the Private Infrastructure Development Group, we offer a financing solution for every different stage of an infrastructure project. And Garanco, its main focus is on supporting local currency debt by providing credit guarantees to banks and capital markets, and other kinds of guarantees as well. Within the Pitch group, we have invested in 3 EV firms. That's through Infraco Africa, which provides early stage equity investment, and Garanco is working on a couple of guarantees for local currency debt to two-wheelers across in West Africa and in East Africa at the moment.
Okay, thank you so much. Next, we will have Paul telling us more about Tugende.
Hi, good morning, everybody. So Tugende offers a technology platform, very much as we head towards becoming a fintech. And essentially, the platform offers four pillars. The first is asset finance for the unbanked and the underserved population. We did start with two-wheeler financing, but we're now product diversified into a number of different mobility products. We've also diversified into other sectors like agriculture, fisheries, retail, etc. We also offer people the opportunity for upgrade credit, digital credit profiles, and last but not least, an ecosystem so that once they've completed their financing and they've taken ownership of the asset, they can continue coming back within our ecosystem and basically help them climb up both the economic and the social ladder in order to improve their lives. So in a nutshell, that's what we do. We have 23 branches in Uganda. We've got 10 branches in Kenya and rapidly growing. We're going to be expanding across Africa over the coming years. At the moment, we've dispersed in excess of $50 million of assets. And yeah, so I work as the Chief Commercial Officer, responsible for the strategy, product development, and marketing of the company at a global level. Thank you.
Thank you so much, Paul. And now we'll have Jafet telling us a bit about WRI and what they do.
Yes. Hi all. My name is Jafet Kirui. I'm the Electric Mobility Coordinator at World Resources Institute, where we support. I support sustainable transport projects in the region. So WRI is a global non-profit organization that works with leaders in government, businesses, civil society to research, design, and carry out practical solutions that improve people's lives and ensure nature can thrive. Our programs focus on major challenges in the intersection of environment and human development. We focus on areas of cities, climate, energy, food, forests, and oceans, where we see them as areas where there is need for change and where change is urgent and achievable by looking at aspects of governance, finance, business, and economics. So we have regional offices across the globes with hubs and program offices. So immobility for us is an issue which is important, and with some of our international offices in India, Latin America, China, and the USA, we've been actively promoting immobility for quite a while, and we're delighted to see the growth of electric mobility in Africa as there's growth in interest in both from the private sector and government. So we've been partnering with governments around the world to advance e-mobility in a sustainable, accessible, equitable way for many years. And through our programs, we help the government businesses to integrate electric mobility solutions with other issues such as land use, energy access, transportation planning, also access to green finance opportunities, where we look at the common framework of avoid, shift, improve, to promote efficiency, improve air quality, and also enhance road safety. So as I've mentioned, we work with all the stakeholders where we plan for, specifically to e-mobility, we plan for vehicle grid integration, coordination with electric utilities, ensuring end users have reliable power for their fleets, and also other projects we focus on policy, road mapping, and also enabling intervention for e-mobility planning. So in Africa, we are focusing in Kenya, Kampala, in the cities of Nairobi, Kampala, and Durban to promote institutional capacity for adoption of electric buses. And also in Kenya, we have the project which focusing on electric two-wheelers and three-wheelers. We're looking at building capacity in terms of finance and enabling policies for adoption. So I'll get to give more examples as we discuss. Thank you and happy to be here.
Thank you so much, Jafar. Yes, so welcome for those who are still joining us. And I would just like to say that that was an introduction part where we got to hear about Gorantco and Tugende and WRI and what they do in the e-mobility sector. And for now, we'd just like to know more about financing, because our topic for today is the instruments for national regional financing in e-mobility transition. So I would like to hear from mostly Guarantco and Tugende on who they finance, who is eligible for financing, and how they do their financing. So maybe we'll start with Guarantco. They can tell us more about who they finance, how they do it. Yeah.
So there are different ways of answering the question. I think the easiest way is to say at the moment we're very focused on two-wheelers, battery assembly and battery manufacturing, and potentially some e-bus firms in the right markets. And the reason is, at the moment, the way we think about it, those are those are kind of the subsectors which are most likely to be commercial soonest. We're also very focused on parts of East Africa and parts of West Africa, specifically Togo, Benin, potentially also Nigeria and Cameroon, and in East Africa, Kenya, Uganda, and Rwanda. Again, mainly the reason for that is those are where the firms are, those are the countries and the governments that have put in place the most enabling environments for EV. The second point I'd make is when we are looking at financing any firm, we are a debt provider, so we provide guarantees to support debt, and we see ourselves as essentially the lender because we're taking the risk in the transaction. When we provide debt funding to any firm, we have to make sure that we're not taking equity risk disguised as debt. We're actually taking senior debt risk. And for EV, this has been challenging for various reasons. One is technology and uncertainty about technology. Two is a lot of the firms, especially in Africa, and I would say that Garanco has also done a $200 million facility in India for EV. But in India, the EV market tends to be much more developed with typically larger firms engaging in EV, whereas in Africa, the second challenge is most firms doing EV in Africa are startups or have been startups and are looking to scale up and are going through that process now. And the challenge as a senior lender and a senior debt provider is, how do we structure the facility so we're not taking equity-like risk? How do we make sure that if for whatever reason the firm, the technology doesn't work or the startup doesn't grow as it's expected, how do we make sure that the debt is protected? And there are structures we've used and we're putting in place to make sure of that. So those are the third thing I'd say in terms of maybe more generally to answer your question, Mercy, how do we work? We have to partner with a bank. So Garanco partners with a bank, and for various reasons, EV firms cannot get bank lending without a credit guarantee. In some cases, that's simply because they don't have 3 years of audited accounts. In some cases, they don't meet the turnover requirements or profit requirements that banks require to lend to firms. So we partner with a bank, we provide a credit guarantee to the bank, and that enables a debt facility to be offered to the borrower, the EV firm. And maybe the final thing I'll say before handing across to Paul is we are specialists in local currency financing. We don't only do local currency financing, but that is what we specialize in. And from my perspective right now, and this is a message I've given to a lot of EV firms, they should be looking at getting local currency debt. It may be cheap. US dollar debt from an impact fund in Europe or the USA may be cheaper, may have a lower interest rate and may be cheaper on the face of it. But if you look at that most of your revenues will be in local currency, and you look at the forecasts for exchange rates, local currency exchange rates against the US dollar, and the extra uncertainty over the next 24, 36 months, even though the interest rate is higher on local currency debt, on the long run, it will probably be much cheaper. So Mercy, I'd say that's the last thing. We are very focused when we look at e-mobility on supporting local currency debt, because we think that will be the most viable solution in the long run.
Thank you so much, Ben. Maybe we can get to hear also from Paul and on to Gende.
Thanks, Mercy. So Tugende is much more than an asset finance company to the unbanked and the underserved population. We finance not only the asset, but we offer what is called a package. So the Tugende package really is all around making sure that our customers have a package that is based around safety and security. So I believe we were the first in the market to offer an insurance package on our products. So we offer medical insurance, life insurance, and product insurance. For example, if we were talking about a two-wheeler boda. We also offer the branding and the safety packages, for example, helmets, as well as a very high quality GPS security system that really helps both us in terms of finding assets that may be problematic or have issues, as well as helping the customers in terms of in the event of theft or other unfortunate incidences. So I think the package is really something that stands out for us. In terms of how we go about doing our business, I think it's quite unique. Our credit vetting process has been tried and tested now since the start of since the company was founded in 2012, and in fact this is our 10th year anniversary coming up. So typically we will look for people to pay a nominal commitment fee to signal their seriousness in undergoing the asset finance journey with us, because it is a commitment that is needs to be taken seriously. There needs to be financial discipline. We do train them on financial literacy, financial management, and basically how to manage cash much better on an everyday basis for themselves and their family, and that kind of spreads throughout the communities that we're targeting. So the commitment fee really kind of filters out, the let's just say the serious applicants versus the less serious. We then usually go for an average of about a 10% deposit, which we feel is kind of the limit at which provides us with enough guarantee, but is also affordable for the majority of the clients that are looking for that financing. So deposit levels really vary kind of between 7 to kind of 12%. So that's why I was just using an average figure of 10%. Then the way forward is pretty easy. You're provided with a package, you've paid your commitment fee, you've paid your deposit, and we do not operate with cash. So we have, depending on the product, we have either weekly, monthly, or quarterly digital cashless payments using a variety of all payment channels, be it mobile money, payment gateways such as InterSwitch or Payway, etc. And basically, at the end of say 104 weeks, which is the usual period for a bike, the customer becomes an owner, usually sells the asset or keeps it and comes back for another asset. So I think the record that we have at the moment is one customer who's at 13 bikes. And obviously bikes, the boaters have been our longest existing product. Our product diversification strategies, beyond two-wheelers, started in 2019. So, we were hoping that we'll have a as successful a track record in the other mobility products as well as non-mobility products going forward. Which brings me to e-mobility. So the way Tugende's strategy is designed is that we're focusing pretty much across the board wherever the opportunities are. At the moment, we have committed, and we do take it very seriously, that we have a green fleet portfolio target. Our definition of green fleet is both fully electric and hybrid. So we are offering hybrid Toyotas in Kenya, primarily for the likes of Uber and Bolt and other kind of fast-moving taxi operators and chauffeur businesses. But I believe we were the first to conduct an e-bike pilot. That was with a company called Zembo in Uganda. We're now looking at, we've now also started a partnership with Ampersand. That's a Rwandan e-bike company that I think we're all familiar with. And we've reached out and spoken with everybody from ArcRide to Roam to Fika Mobility, Mazi Mobility, etc. And the idea is, whoever is ready, both in terms of product, reliability, performance, funding, etc. We're here to help scale up. I think financing is probably the one thing that everybody looks at, says, oh, we'd love to scale up e-mobility, but where's the money going to come from? So I think looking at Tugende's model, which is pretty robust and very, very well tested, we believe we're in a pretty strong position to be kind of the partner of choice for anybody looking to scale up. Obviously, the companies do have to be ready because brand reputation does matter to us. We take it very seriously. So the last thing we want is to be offering customers, products that are either unreliable or do not perform as they were promised, etc. So we do have pretty intense discussions with any of these startup companies. We look at their level of professionalism, their product quality, their funding, their strategy, their recharging or battery swap infrastructure going forward. So we're still in a nascent stage. We're still conducting pilots, but the good news is that we're underway, and hopefully the scale up will follow.
Thank you so much, Paul. I'm loving the questions in the chat because I feel like so many people are interested in knowing how they can get finance. I think Tom will handle that. But then for now, I'd just like to, before I get back to you, because I have questions for Ben and Paul, but I wanted to hear from Japheth. I wanted to know, in your experience with WRI, have you encountered some of these finances, and what are some of the challenges that people are telling you about in your research when it comes to financing from any of these organizations that you've interacted with? Maybe Goransco or Tugende or even another institution that is financing.
Yes. Thank you, Marcy. So I think I'll just start by giving a bit of background of how we do research, because we feel like we need impact, and the background of this is to have national level dialogues. We look at global processes. Then we use our research analysis and tools using on the ground projects to have information and research that is really impactful towards the industry in all aspects, as I mentioned earlier, business, governance, and financing. So as we talk about financing and uh, challenges in financing, in our experience, we have come across a lot of barriers that are in the electric vehicle industry. We look at the cost of the technology, infrastructure availability, and also electric mobility policies, and also consumer behavior. But at the peak of this all is financing, which is in terms of cost and also the quantum capital of in terms of setting up industries and infrastructure. So we have ambitious plans for manufacturing and assembly, and also for charging infrastructure deployment. And all this require a lot of innovative technology as well as pioneering finance. And since there's currently a shift towards sustainability in all aspects of living and businesses, and also in all the environments, we look at transportation efficiency is becoming important. And for this shift to happen, we need to have innovative we need to have competitive manufacturing and assembly, and also robust infrastructure. And building out this capacity will require a lot of billions of dollars, or a lot of money, just to finance this change in both government and private sector. So while we'll still accept that the electric vehicle revolution depends upon a bit of technological innovation, and also what is less appreciated in most, what is looked at after as an afterthought, is how the innovation required in financing. So banks and investment funds must also acquaint themselves with the technology and also the economics of the industry and how it's maturing, so that they're able to be comfortable to take the risks, and also to find themselves being comfortable in supporting the industry. So what challenges we're seeing in terms of how we interact with stakeholders? We're seeing some level of high interest and insurance rates to some retail loans. We have also loan to value ratios are a bit low, and also specialized finance options are limited. So this is part of the challenges we see. And once as we do more research, we look at what solutions can we see, and what solutions are we able to share with the industry. So using consultations, we find we have solutions like credit guarantee schemes, which can de-risk startup manufacturing, assembly, and charging infrastructure deployment. This this will make them bankable and can access some working capital and trade finance facilities. Also, a solution could be some level of government involvement in incentives such that uh, components such as batteries and how the Ministry of Industrialization in Kenya is looking at completely knocked down units for electric two-wheelers and three-wheelers, and also the setup of special economic zones. Another solution is also subsidies in terms of revolving co-financing in terms of to achieve some level of price parity, and also specialized lenders can be provided with demand side portfolio guarantees to ensure they provide affordable credit financing to electric vehicle users, and also look at secondary market development. So this secondary development, which is led by industry, we can have some buyback programs and ensure battery reuse scheme, which will help manufacturers and governments catalyze a secondary market for EVs. We also have risk sharing, where mechanisms and facilities that partly or entirely cover possible losses associated with financing EVs, because now we know it's very unclear of the resale value of electric two-wheelers and three-wheelers. So such mechanisms will distribute risk and provide financial institutions with opportunity to build trust in the sector. Also, in additional, we have other enablers like digital lending, as I know many financial organizations are working on that. Also have, as Paul has mentioned, piloting and innovative new business models where we can see the combination of flow of capital, which will demonstrate the potential of the sector. So I think that's just a quick highlight of what we are seeing in terms of how we interact with stakeholders, and as we continue doing our research, we work with both the users and also the financiers and government, and we keep publishing more information. And yeah, I think that's my contribution as at now. Look forward to adding more in the coming session.
Thank you so much, Japheth, for that. And maybe we can go back to Ben and Paul, and maybe we talk about some of the challenges that Japheth has pointed out. Maybe you can tell us if there's anything Guaranco or Tugende is doing to address some of the challenges people are experiencing in terms of financing. Especially another question that I had thought I would just put it in here was the whole idea of how do you manage these assets, that how do you, once you've done the financing, how do you ensure that you don't go at losses as a company, and also how do you make sure that the finances that you're giving out, you can account for them? That is the accountability on the part of the financer and also the person receiving the finances.
Sure, I can maybe briefly start and then hand back to Paul. What I mentioned before, some of the challenges we see providing debt to EV firms tend to be quite small and startups. The technology, there is a question mark over it, and there is also an ecosystem. There's a question mark over the ecosystem. If the ecosystem were more developed, then providing debt funding to any single EV would be probably less risky, but there's a lot of work that needs to be done in that area as well. The way we think about this and the way we get more comfortable with it is by structuring facilities which require a large amount of equity as well. Japheth mentioned some of the LTVs. What we're seeing is the LTVs for EV firms looking to scale up, it's more than 50% equity funded and less than 50% debt funded. And it's asset-backed lending as well. So asset backed, and the assets are the bikes and the batteries. I mean, in the cases of the batteries, the LTVs can be, are very low. It still makes sense to the firm because it reduces the cost of capital, but the LTVs are very low for the batteries. That's the first thing I'd say. And the second thing I'd say is we are looking only to work with firms, and I think Paul mentioned this as well, where there isn't, where they've got over the piloting stage, where there isn't reputational risk, where they've reached a certain stage of development where the technology is proven, where there is enough data and customer data to show that it works. Look, maybe one of the questions in the chat is comparing the kind of pay-as-you-drive model to pay-as-you-go solar home system model. There are a lot of similarities with it. I think what we have seen is the repayment speed and the repayment rates in the kind of pay-as-you-drive model are much higher, and that kind of reflects the fact that a lot of the bike use is used as an asset, being used as a revenue generator by customers who tend to be taxis or similar. So there tends to be a much better repayment speed and much better repayment rates. But in other respects, the way we approach the debt funding is very, very similar. Those are kind of the main challenges we see in the sector and at the moment, and how we address it.
Thanks, Ben. So I think for us, what we're seeing is, as a company, our biggest issue is probably, and this is where I think I need to speak to Ben offline, is it's not a lack of demand. The demand in the market is huge and it's actually growing. The issue is us not having enough debt or equity funding at any given time. So money comes in, money goes out. We go running off to kind of raise more money. So I think having more kind of stability in the debt and equity funding pipeline for us, and I think any other kind of early stage startup company, is key. We are going through our Series B round at the moment, so hopefully that will give us more kind of room for breathing, so to say, instead of constantly chasing cash. I think it's not a case that all financiers are have a huge bank of cash that's available at any given time. So one of the challenges obviously that we have and others in this space have is obviously we have to cover our cost of borrowing, right? And as Ben had said at the beginning, do you borrow in hard currency, or do you borrow in local, or do you have a hybrid model, or how does it work best for the various companies? So obviously the money that we lend out has to cover our cost of borrowing plus whatever other OPEX and CAPEX costs that we have, before we even get to the point of how much margin are we going to earn as a finance company. Now, because Tugende is a social enterprise, I think that is the key differentiator between us and other direct or indirect competitors, or even the banks or other microfinance institutes. We take the social impact angle extremely seriously. We've impacted, I think the latest figure is over 1 million lives, and growing. So when it comes to the way we operate very differently. We consider ourselves to be very flexible and very human in our approach. Remember that the people that we are financing are really hand to mouth, right? There are emergencies that come along in their lives. For example, if there's emergency medical expenses, hospitalization bills, funerals, etc. So we do use a very high touch business model. We're in touch with our clients frequently, regularly, both by visiting them at their homes, in their villages, calling, SMSing, communicating through our app. which continues to offer more and more services. And I think the fact that we have a huge amount of customer relationship officers, communication is very, very important. Getting to understand what people's challenges are. Coming to what Japheth was saying yesterday in terms of using that feedback to say, okay, what else can we do? How can we evolve and how can we become more innovative and potentially pilot? So one of, I think the other differentiator with us is because we've got a very extensive and well-experienced product development team, which uses a very well-developed and robust product development process where we're going through the research stage, feasibility, piloting, post-pilot analysis and evaluation before we mainstream it, using a kind of a 10-year scale-up plan. That allows us to really test what works, what doesn't work, what needs to be improved, what needs to be discontinued, etc. So in a nutshell, I think that's where we are, but I think the takeaway here is the demand is huge and growing. We would love to have more debt and equity funding. We're here, we're ready to pilot with literally anybody as long as kind of they tick the minimum boxes in terms of what I'd mentioned earlier, product design, performance, pricing, after sales backup, warranty, etc. But I think the other kind of elephant in the room question is at the moment we have a number of e-mobility startups in Africa, predominantly in Kenya when you look across the continent. However, at what point are the OEMs themselves, if you're looking at the bikes, when are your Bajajes and TVSs and Honda going to come in themselves with their own e-bike products? I think that's one elephant in the room, and I think the other one is really around what is the government policies around emissions, around subsidies, around the recharging battery swap infrastructure. How much are the governments gonna invest themselves? How much is the private sector gonna invest? What are the interoperability issues? What are the wider discussion points across, for example, EAC? When somebody goes to Uganda or to Tanzania or Rwanda, are they going to be able to charge their car, or is the plug different? So I think there's a lot to be discussed. Like I said, I think we're still at the nascent stage, but I think the more companies like Tugende can offer the financing to go through the pilots, to help learn, the quicker we can all, jump on the bandwagon to help scale up e-mobility, which I think we all want to see. But I think the political will and the legislation going forward is going to be absolutely critical. We're hoping what we're seeing from the new president, that he is very pro e-mobility and has promised that the country will be fully renewable powered by 2030. So let's hope that we get the momentum from the State House as well. Thank you.
Thank you so much, Paul. Before I go back to Japheth, I just wanted to ask a quick question to Ben and Paul. From someone with a startup asked me this question. Do you have a limit of the amount of money you can give to a startup? Because I'm sure there's a range of the amounts you can give to a startup to be able to develop their startup better. So do you have like a limit? Could you give someone, like, for example, $1 million to improve their startup, or what is the eligibility for someone to get a certain amount of money from your from your side?
Yeah.
So we finance the end user. We don't finance startup companies because we have that social enterprise angle. So another key differentiator, sorry, I should have mentioned this before, is we do not finance what we call landlords, right? So we will finance the actual operator himself, because that's where you get the life transformation event. So we don't invest in startup companies. So Ben, over to you.
Yeah, it's a very fair question, Mercy, and I guess the point that I'm trying to make is we also don't finance startup companies. But as a lot of these e-mobility firms have carried out their pilots, they've done their testing, they've de-risked the technology, and they're looking to scale up, then we can come in with the financing. And typically the minimum financing is $10 million, but our average ticket size is much more than that. And what we're providing is asset-backed financing. So as the firm grows and as the two-wheeler firm sells more bikes, generates more receivables, or buys more batteries and creates a larger asset base, it is able to draw down more on the facility. The other quick two things I'd say is within the private infrastructure development group I mentioned at the beginning, we aim to be a one-stop shop. We also have Infra Africa, which can invest smaller ticket sizes as equity into startup firms or firms which are much smaller. And then the third thing I'd say is, and maybe just in response to what you said before, Paul, about the challenges you see on the horizon for e-mobility firms and potentially OEMs coming into the market as well. The way we see the market at the moment, especially in the two-wheeler space, is there are two distinct business models. There's Paul, what you do and what a lot of other people do, selling the bikes and owning the customer relationship and owning that relationship to make follow-on sales and monetizing the relationship with the customer. And then also the battery swap centers. And there are different challenges potential challenges going forward for both of those business models. In the swap centers, there's a question over in government policy and how the standardization of batteries and swap centers might affect their profit margins in the future. From a financing point of view, we look at both those firms and we look at them, as I keep saying, the challenge we have and what we try to do is provide debt. So it is debt and not equity. So it's structured correctly, so it's asset backed and secured. And what we're seeing, Mercy, is, a lot of firms are not quite ready for $10 million, $20 million equivalent in local currency debt funding, but probably will get there in the next 24 months if they scale up and in the way they want to. And that's both on the bike side and also the battery side.
Thank you so much for that. So we've spoken about financing from the perspective of your different organizations. So you've talked about Guaranco, what they do, Tugende, what they do, and WRI, what you're doing in terms of looking into instruments for financing. But then I would like to know now, generally in terms of Africa or nationally, globally, I would like to get your perspective on financing when it comes to the regions and the countries. And then also, is there any opportunity to harmonize or learn from other finances? Maybe you've interacted with some finances in the field. Is there any opportunity to harmonize? Or, I don't know. I think that is my question for the three of you in terms of Africa and the region at a whole. I want you now to discuss financing from that perspective.
Maybe I can just jump in and just to build up on the earlier discussion on by Paul and Ben on the product offering. So as I mentioned earlier, we have been focusing on policy road mapping and enabling interventions to for planning and equitable transition towards electric mobility. So just one of the interventions we are currently working on. WRI is a NAMA support organization where we are currently collaborating with various stakeholders. This is government to launch the Kenya Small Vehicles Electric Mobility Project. So this is a financing facility which seeks to assist the market to create momentum in the electric mobility transition. So we are currently at a detailed preparation phase. So this means that we're really working with financial organizations, working with government to make sure we have the right level of right figures and information just to enable to build up a strong proposal towards receiving these funds. So this will be an approximately about $17 million to incentivize and de-risk investments in electric two-wheeler and three-wheeler sector. This is by focusing on the manufacturers and assemblers. So there'll be two components. We'll be looking at the demand side and the supply side. So this will have many forms of, we'll structure this in different forms in terms of credit guarantees, in terms of revolving subsidies, in terms of to access the electric two-wheelers and three-wheelers, and also for manufacturers to build the capacity to be able to sustain orders and stock. So this is just one of the interventions, and at the same time, we'll work with, as you know, we are a research organization, so we'll work with a financial institution who will administer this funding, and this process, as we're looking at a regional approach, if we're successful, I know this approach will guide other countries in the region in the electric mobility transition. And also this project is currently at a detailed preparation phase, and we look at more involvement by other regional funds. So we look at this as an example towards a regional approach towards having financing instruments that will really have greater impact towards electric mobility companies and adoption. Thank you.
Thank you so much, Jafet. Maybe Paul and Ben can chip in on the infrastructure, financial infrastructure in Africa and in other countries other than the ones you've worked in.
Yeah, thanks, Mercy. So from our perspective, and based on our strategy, we're seeing an East Africa first stance before we go into I think West Africa will probably be the next region, and the reason for that is really based on the following points. Number one is, what is the level of development in the mobility ecosystem in country? Where we currently are in Kenya, I believe is the furthest ahead on the continent as a whole. So I think that's very important, because that really determines people's mindsets, the public level of awareness, potentially the level of supplementary services that are available, etc. The second is looking at the amount of startups in the country as well. Third is, obviously, as a finance company, is the sophistication of the financial services space. We would rather not go into a country if government legislation was not at the level that we would like it to be, if there's a lot of red tape, if it's very difficult for us as a company to operate, then obviously it's going to be more cumbersome for us to penetrate that market and serve the startups that we're looking at. And I think market size is the other one. Where would we invest our dollars? We have our own kind of selection criteria and country scorecard system that we look at. But I think the main one is government policy. And that's why, I'm quite excited about hopefully what's going to be happening in East Africa, driven by, I think, Rwanda and Kenya, in terms of how far ahead the government is in their thinking. So yeah, that for us really would be the answer to your question in terms of the regions, kind of where and when. I wouldn't put any dates on it at the moment. I think East Africa has a lot going for it for the foreseeable future. You do have countries like Ghana, Senegal, Cote d'Ivoire, I believe, that will probably be the front runners in West Africa. But there could be other countries that suddenly surprise us with new legislation, the likes of Togo, Benin, etc. So we're constantly doing the environmental and market scanning, and ready to enter those markets as and when we feel the timing is right.
Yeah, and look, I agree with what Paul's saying about the regions and the countries to focus on, and also the criteria. I'd add one thing, and that is the gas and petrol prices. And we look at Zambia, Ethiopia, and both markets should be promising for e-mobility, but they haven't. At the moment, we're not seeing so much activity there. So maybe, Mercy, I'll just answer your question in a slightly different way in terms of the financing infrastructure, and also compare East Africa to our experience working in India. We look at the landscape as kind of early stage equity, follow-on equity, and then the availability of local currency funding and also hard currency funding. I think in East Africa in particular, there is a lot of early stage funding, but both from kind of foundations and concessional funders, and also from early stage equity funders such as Infraco. In terms of the follow-on equity space, we're not sure how deep the market is. It's obviously being tested by a few firms at the moment, but there are potentially challenges there. In terms of hard currency debt, that there is, I think it's going to get harder to raise hard currency debt, and it's probably going to be, but it is there, and it has been there, for instance, for the solar home system firms. But it's probably going to get harder, and especially getting it from private markets. And then in the local currency space, which is, as I've talked about, is what we focus on, especially for EV. It's hard for firms without a track record, irrespective of the sector, to raise local currency debt. There are obviously a few multinational local currency lenders like Stanbic Absa and Stan Chartered, less so Stan Chartered, but Stanbic and Absa who have the ability to lend to firms in different jurisdictions. But the other challenge is otherwise you're looking at banks which are very much just nationally focused, and most EV firms, if they're looking at a regional solution, will struggle to make that work. So that's the space where Garanco can probably make most of an impact and most of a difference.
Thank you so much, Ben, Paul, and Japhet. I think I would like to pass it over to Tom now, because I have so many questions. I know we'll never get to the end of this, because I know it would be nice to hear from our participants also. Yeah, thank you.
Thanks, Mercy. Yeah, like you said, there's a lot of really interesting questions in the chat. So I'm going to have to make a choice here on something to ask about. And I think a really key question here that was posed here by Huashan Wang, I hope I'm pronouncing that correctly, is asking about where the financing focus is right now. So they're asking, is it on the supply, tech and development side, or on the distribution and service side? And more broadly, where are the financing gaps? Like, where do you all see the financing gaps? I'd love to hear from you all on that.
Or maybe Tom, I can say in terms of the financing gaps, I think that's what I tried to kind of summarize in terms of early stage equity, follow-on equity, local currency debt, hard currency debt, and I think there's potentially a gap in follow-on equity for EV firms, and potentially an important gap in local currency financing. And in terms of, I'm not sure I fully understood the first part of the question, but in terms of where financing is most available, I would say it is in kind of almost the early stage equity to help in small ticket sizes, to help firms and to test the technology, to do the pilot studies, and to make sure they are ready to scale up before they access larger ticket sizes.
Yeah, if I can just add to what Ben said, which I fully agree with, is we would like to see more grant funding as well. We've worked very closely with the likes of Shell Foundation and Siemens Stiftung. And I sit on the kind of the e-mobility acceleration kind of task force teams of both. But I think grants from a number of the Western countries would be fantastic. You know, obviously followed by the debt funding as well. But my feel, having spoken with most of the e-mobility startups, is the funding gaps that they're struggling with on scaling up their battery recharging and battery swap infrastructure. So I think on the product side, they kind of get it over the line, going through their different versions. This is primarily on the e-bike side, which is a relatively inexpensive product. But I think on the infrastructure side, we need to see some very large, big ticket investments being made, and preferably at a regional level. Because if you look at, for example, what the European Union is doing, you know, it's all around standardization, interoperability, and just making sure that people can seamlessly move across borders. Obviously, in the EU, it's a lot easier because there's borderless travel between 25 plus countries. But when you are a government, you know, you should be looking at policies and strategies that are going 10 years and beyond. So if I can just limit this particular point of mine to the East African community, I'd love to see, you know, borderless movement across the EAC, where I'm able to take my e-bike or my e-car or my regional bus that's electric powered seamlessly across the borders, you know, without any issues. But I think we need to see a lot more grant funding, and equity and debt funding as well, and you know, larger ticket sizes as well.
Yeah, and I think just to add on that, as the question was on where the focus is, just to add on that, I know financial institutions also need access to data on electric vehicle specifications, real world drive cycles, actual charging costs, operating expenditures, and this will help these institutions accurately assess risk, determine appropriate interest rates, and also design effective financial products. So as also companies, I know there's a level of information that can't be shared, but there's what a financial institution needs so as to be able to accurately determine the level of investment and the level of funding that can be if can have an impact in terms of making use of the available financing. So I think that's an important key and also key information. And also, as we talk about policies and also technical assistance in terms of coming up with good policies, also this data is key in terms of for governments to effect good policies that will have good impact. They need to have data. They need to know how the industry is developing and how the decisions they make will accurately have some just transition in terms of the already existing internal combustion engines and how that affects jobs, how that affects other sectors of the market. Thank you.
Sorry, can I just add? I think a lot more can be done by the DFIs. I know that there's been quite a lot of talk, kind of like the UK. But I think looking at the large mobility countries, where a majority of the OEMs come from. So you're looking at North America, you're looking at the US, Germany, France, in particular from Europe, the UK, Italy, and then in the Far East you've got China, Japan, and Korea. I think what we can do as a body of e-mobility kind of pioneers, so to say, on the continent, is raise our profile. I think we need to do a lot more lobbying, and market ourselves a lot more to those countries, because I think there is a lot of nascent money that's sitting and is available. With the global macro and micro situation that you're seeing, I think people are looking at good returns, and what better place to put it than in certain African countries. So I think you know, it's a two-way thing. We need to raise our profile and build that awareness, by providing them with the confidence that, you know, they will get the right returns. But I don't think Africa is going to be able to do it on its own. I think we do need the big money coming from the big countries.
Yeah, thank you so much. I think that's a really important point in terms of promises for funding from the West that is yet to come through. But it's time for us, unfortunately, to close this panel. But there's a lot of really interesting insights. Thank you all so much. Mercy, thank you for moderating. Paul, Ben, Japheth, really appreciate all of your insights from across the board. Yeah, thank you so much. We're looking forward to having you on Saturday. We'll be starting up our next panel now. So we can go ahead and start that transition if we can get the next panelists to share their screens and join us. Again, thank you so much for being here and having this wonderful conversation.